Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Merryn Talks Money Market Wrap, where we talk about the biggest moves in the markets this week and what is driving them. I'm Merryn Somerset Webb, editor-at-large for Bloomberg UK Wealth.
And I'm Stepek, senior reporter and author of the multi-award-winning Money Distilled newsletter.
Oh, this is painful. Can I just ask all of you award-giving institutions, just stop. Stop validating this man.
Yeah, it's true. My head barely fits in the screen as it is.
Or at the very least, give me the awards. Let me have some.
Your shelf is much bigger than mine still.
Yeah, well, they're all old. As you know, we got that great one last year, didn't we? Best broadcaster.
Yeah, that was a good one.
Yeah, for our award-winning podcast. Right, yeah. Anyway, enough of that. So we did another fantastic pod earlier in the week because, you know, we are an award-winning podcast, right? And that was our chat with Roger Lee about the hideous fiscal position that the UK is in and how it might, non-zero risk, bring down the government, cause a constitutional crisis, etc. There was a lot of comments on that one. Half of them saying, you know, don't be ridiculous, what's wrong with you? Find me ahead of rates with this take and I'll sweat. And other ones saying, wow, that was really, really good. One of the best explanations I've ever heard. Brilliant podcast. I'm with those guys, by the way. So it was interesting. You listened to it, right, John?
Yeah, I thought it was great. I thought it was very clear, and honestly, I get that. Obviously, everyone's got their own political views, and a certain amount of partisanship will come into whether or not you think it was good or not. But I did think it was. You know, the UK's finances are in trouble. They are comparable to France's, and France has had a constitutional crisis. So, you know, I certainly don't think it's not a crazy idea to think that it might cause the fall of the government. It's, you know.
Although interesting, one of the comments questions that came with it was so the pound will devalue. Does that mean some of your cash should be put in euros? Well, you know, that's not really the answer. I mean, it may be, and we do have a podcast coming up, by the way, with Dominic Frisby just on gold. And one of the things we point out there, it is totally possible for all currencies to devalue at the same time against gold, right? So the European economies aren't necessarily in a significantly better position than the UK economy. So it's not really a matter of, well, things are crap in the UK, so I'll go put my money in a currency that represents, France.
Yeah.
So watch out for that as a thinking that that's an obvious thing to do.
Honestly, if I was really, really worried about currencies and I wanted a fiat currency, the dollar would still be the one that I went to. Anyway, just saying.
I mean, there's a reason, right, that gold is up 47% this year and silver is up 63% this year, 17% in September alone. There's a reason for that, and it's not because the euro is a better currency than the pound. We might come back to that. There's another question from David. Thank you, David. In your Labour Tax Talk podcast, you stated that any attack on DC pensions wouldn't work because it has to also affect DB pensions, to be fair. And he doesn't really agree. He thinks that's not a reason for it not to happen. I guess he thinks that everything is unfair, so why wouldn't this be?
Oh, I think David's point, a quick look at that, was he was saying, well, how come the IHT thing, which only affects DC pensions rather than DB ones? And I think the point there as well, because it doesn't affect DB pensions, it wasn't a big deal. So the inheritance tax move.
I suppose that the key thing there is that you would say that why would inheritance tax affect a DB pension, because a DB pension dies with you, so who cares about inheritance tax? But of course it doesn't always, does it? Because it goes to the spouse or a partner, etc. And that doesn't necessarily have to be inside a marriage. So I guess there's something there, but it's not quite the same.
There's something there in that, you know, it's taking a benefit away from DC. You know, okay, there wasn't in DB in the first place, but DB's got other benefits that DC don't get. I get the irritation, but I also see why, politically speaking, it was a very easy move, whereas the other way about is not. Yeah.
Agreed. There was one other email that we enjoyed from someone in Turkey about adding some gold and some silver to her portfolio. And of course, what we were talking about last week was the Turkish portfolio, where you have effectively half gold and half equities to protect yourself against inflation, etc. And she says salaries in Turkey are being eaten away by inflation. Join the club. And as a teacher, I feel this very strongly in my everyday life. That's why I decided to change the way I invest. So a Turkish portfolio from Turkey. Fun, I guess.
That's really interesting. I mean, look, one thing you can say for terrible economic mismanagement is that it makes the average person in the street a much more sophisticated investor.
On the subject of terrible economic mismanagement. The UK stock market, which of course we are great fans of in terms of the wonderful companies trading on the stock market at kind of rubbish prices, and we feel and we still feel that there is value there, but the de-equitization of the market is really starting to get very, very serious, right? And almost no IPOs in the UK this year, and you pointed out to me earlier, and there've been quite a lot of talk about it, that we are now on the list of markets that have IPO'd or done IPOs over so far this year. What did you say? Number 23?
We're at number 23.
After pretty much everybody you can think of.
Yeah, I think in terms of big markets, we're still ahead of Italy, which is like number 30. But the fact I'm calling Italy a big market in this context shows you just how low we are. We're behind Oman, which is a frontier market. It's not. It's really, really kind of ugly, and you can patch it by saying that, well, yeah, but there's meant to be some IPOs next year, and I'm sure if you look down the list, you could see that there were reasons why the IPOs were in the places they were in, but it's pretty ugly stuff, and I did notice a lot of people commenting on it. Yeah. I mean, a lot of kind of Twitter follower people were sort of saying, oh my goodness, does this mean the city is doomed? And you're kind of like, well, okay, this isn't actually the city's core business, but that is part of the problem. Well,
it's all part of the network, isn't it?
Yeah.
I mean, it's all part of the infrastructure around finance, law, etc. In London. The stock market is at the core of that, and its shrinkage does matter. It matters for all sorts of reasons, but it's becoming urgent. And policymakers have been told about this over and over and over and over again. I mean, how many different lunches and dinners and talks and blah that you and I have been to over the last decades, talking about the miseries of the UK stock market and how it can be fixed, and absolutely nothing ever happens. You get a little fiddling around on the supply side with regulation, etc., but nothing real. And this stuff that came out, I think it was just this morning, talk about cutting stamp duty for new IPOs. This is nothing. This is nothing. You should cut stamp duty across the board, but cutting stamp duty for IPOs, this is nothing. Most countries don't even have stamp duty. This is not getting us ahead. This is just getting us very slightly less behind. It's a nothing. Incredibly frustrating.
Yeah, no, it is. It's a real waste. I mean, I don't know. A lot of people have talked about the stock exchange should be spun out of LSE Group, and I mean, I don't think that's the core problem, but I do think that if it was just one person's job to make the stock market better, that would actually help focus things a bit. So I mean, I don't think that's necessarily the solution, but I'm certainly not against it.
Yeah. Okay. Well, let's move on to more jolly stuff. That we could talk a bit more about gold, but that is not jolly. Obviously, it's the anti-investment. You don't want gold to go up. The fact that gold is going up might be marvelous for your portfolio if you've been listening to us for years, but overall, it's not a good thing. You want that to go back down again. So let's all hope for that. However, if you own American tech stocks or America, you're pretty happy too, right?
Yeah. They just keep going up. They just keep going up, and even although there's various signs of bubbliness and all the rest of it, that's just showing those signs. And also the US government entirely shutting down. Obviously, that's a good thing. Nobody cares. I think we should try it here.
Yeah, and it's interesting seeing, I mean, one of our colleagues has written about this, seeing that, we were constantly worried, all of us, about the market narrowing in the US. Magnificent 8, Magnificent 7, the Magnificent 5, the Magnificent 4. But now it is totally widening out again, and you can begin to talk about a new group. I mean, which of our colleagues wrote about this? I can't remember, but they said maybe we can talk about the golden dozen now.
I mean, yeah, I don't know what to make any of this, if I'm honest. It's, on the one hand, you've got all these stories about NVIDIA kind of buying chips. No, what do they do? Yeah, no, they've got a little company. No. They invest in a little company that then buys a load of chips from them, and then they rent the chips back from them. Yes. And then they're all investing in each other. So OpenAI is investing and buying stuff from this one, and then that one's buying stuff from NVIDIA, and then that one's buying stuff from Microsoft. So there is a sort of circularity to everything. And also there's a lot of private money involved, so it's somewhat more opaque how this all works. And it does feel kind of .com-y from that point of view. At the same time, there's not the same sheer nuttiness that there was at .com. Like, all of these companies do make money, even if we're not entirely sure how they're spending it or what the accounts are going to look like once everybody's rented everything from everyone else. So I couldn't even, it feels bubbly, but I couldn't even begin to say whether it's, 1996 or 1999 or not. That's not the case at all. I don't know.
All right, I'm going to file all that under proceed with caution. But there's something else that I want to point out, some new and semi-exciting bit of information. And this comes from a note from AJ Bell, where they point out that it's been a really good year for the UK, right? I'm leaving the US and going back to the UK. It's been a great year for UK shares so far, but it's been even better for a particular kind of UK funds. Do you want to guess?
Have active fund managers actually managed to do something?
Yes.
Well, hey.
Yes, they have. Hey. In the battle of the manager versus the machine, humans have been punching above their weight with UK funds so far this year. In both the UK all companies and UK equity income strategies, the top 10 performers were dominated by actively managed funds.
There we go. See? Eventually, every dog has its day.
Oh, that wasn't quite how I was going to frame it.
Okay, well, so what's the top one? Give us a rundown of the winners.
Well, SVS Zeus Dynamic Opportunities, followed by Artemis Smart GARP UK Equity, GARP Growth at Reasonable Price. 91 UK Special Situations, Dimensional UK Value, Artemis UK Select, Brompton UK Recovery, a lot of recovery going on here. Then you get a couple of ETFs, and then you get Red Wheel UK Climate Engagement. It's kind of interesting. And most of the climate related funds and renewable energy related funds are having a pretty nasty time. And then you get the Invesco UK Enhanced Index, about which I know nothing, but you get the general sense from the phrase enhanced index.
There's a bit of a value theme near the top there.
Value, recovery, etc.
Select even might be. I would take a punt that might be a kind of value fund, but I could be wrong.
So that is interesting. So on one side of the Atlantic, you're getting a lot of tech stuff coming through, huge outperformance there, and on the other side, we are back to active value. So very different markets, which is in itself kind of interesting.
But I mean, I guess this is good as well, because at the end of the day, most of the people listening to this are, even if they're quite active, are still going to have a fair chunk in the US. So if the US is still going up, even if you're underweight it, US is going up, value's going up, gold's going up, the actual environment might feel a bit scary, but it's been brilliant for basically anyone who invests in almost anything that isn't a gilt or a treasury. It's been a very, very good year so far.
I think it's
which is the other reason I'm paranoid about it. So I like ending, but that's beside the point.
Yeah, you're such a doom and gloomer. We must remind everybody, by the way, that the other market that has done extremely well, that we have been going on and on and on about for forever, is of course Japan. And last month the Topix hit a new all-time high, and I know the Nikkei did that a while back, about a year ago. But the Topix is for your professional investors, but more faith in the Topix than in than in the Nikkei because it's a better index, basically. So that hitting a new high last month, that was kind of exciting and suggests that Japan maybe it really is back.
I mean, that is exciting. And we saw, we've got a colleague here, Geroyd, who writes a lot about Japan. And he was making the point that young people in Japan are queuing up to put their savings in their kind of ISAs, which is a big change as well. So put their savings in equities in their ISAs, and that's something we used to talk about, hoping that domestic savers would come back to the Japanese stock market, and that sort of culture change finally seems to be happening. It seems to be inflation can be quite helpful in triggering behavioural changes.
Getting people out of cash, yeah. Not so much here, though. Not so much here. But we're not going to continue the UK misery fest. We're not doing that.
And I suppose interest rates here kind of have gone into, well, they kind of went into giving you a real return again for quite a while. So I can see why people might have loaded up on cash.
Yes, but now what we want them to do is get rid of that cash and put their money into the UK market and make it go up. And if it goes up and it keeps going up, then companies will come here and IPO and everything will be fine. Right?
Hooray.
Yes, and that's where I'm going to end it, because everything is going to be fine. Thanks for listening to this week's Merryn Talks Money debrief. If you like our show, rate, review and subscribe wherever you listen to podcasts. Also be sure to follow me and John on X or Twitter at MerrynSW and John_Stepek. This episode was produced by Sam Asadi, production support and sound design by Moses Andam. Questions and comments on this show and all our shows are always welcome. Our show email is merrynmoney@bloomberg.net. Don't forget that if you have enjoyed our podcast, you can hear more from me and John and all of our brilliant colleagues by signing up for a Bloomberg subscription.